Hey guys, Frank Minetti, Branch Manager, Advisors Mortgage Group Freehold. Hope you guys are doing awesome out there. Just want to come to you with an awesome topic regarding wealth creation by purchasing investment properties. And I'm talking about legacy wealth, wealth that you can pass on to generations down the line, and also help build up income for you and assets when it comes time to retire. So what am I talking about? I'm talking about purchasing investment properties. And I want to give you guys a real world example. I sat and I worked through these numbers and it was eye opening. I was actually working with a financial planner on one of their clients, and their concern of that financial planner's client was they didn't have enough assets to retire. And they were a little bit younger. They were starting, in their 50s to now start to really think about retirement, and they felt like they were a little bit behind the ball. So, other than what the financial planner wanted to put in place for them to help them retire and have enough assets and income to last through their lifetime, we looked at doing something a little bit outside the box, and that was investment property purchase. And I have some notes here. I don't typically do that, but I don't want to miss anything here. I want you guys to get accurate information regarding this. So, and I'm using the environment that I work out of with regard to like property taxes and purchase price ranges and things like that. And I'm based out of Central New Jersey. So again, you want to talk through specifics about investment property purchases, click the link in my bio and we'll do a one-on-one conversation about the whole thing. But I want you guys to plug in here and listen, right? So let's do a real world example. Let's take a purchase of an investment property, $350,000 investment property. And they're out there. We're starting to see some inventory creep back on the market, some price points a little bit lower, giving an opportunity to buy affordable properties. So $350,000 investment purchase, let's say we have you put 25% down. You could put as little as 20% down, but the reason why I chose 25%, it's a more favorable interest rate environment. So what are you going to do? You're going to buy for $350,000, put 25% down. You're going to finance $262,500. And let's say, an interest rate somewhere right around 5.5%. Investment property rates today are a little bit higher. They've been obviously historically a little bit lower. I just wanted to choose like kind of a middle of the road situation. And also assuming taxes right around $8,000 or so a year. So all in, that mortgage payment is going to be $2,258. Okay, so I don't know about you, but rents in my area, 3-bedroom homes, 1 bathroom, bath and a half, are renting anywhere from $2,400 and above. For our purposes today, I'm assuming this property rents for $2,500. So let's look at your all-in investment. Now, this investment for your down payment can come from other sources that you have. It can be liquidated from your 401k, your IRA. Again, consult your financial professional, and we'll work in conjunction with them to see if this makes sense for you. So you put down 25%, that's $87,500. Assuming closing costs of approximately $12,000, your out-of-pocket investment is $99,000. And you might say, well, that's great, Frank. My mortgage payment is $2,258. The rental income is going to be $2,500. I'm only making $242 a month here. It's actually a little bit more than that, but I've adjusted for 15% off of the rental income, assuming that you might have the property vacant, changing over tenants for about 15% of the time. So what I've done here, I played this scenario out over a 15-year period of time. And you might say, well, $242 a month doesn't thrill me. Well, it doesn't thrill you on the surface, but let's dive a little deeper and drill down on these numbers a little bit further. So you've invested $99,000. What happens 15 years from now? Let's say you're 55 years old, you purchase your first investment property, now you're 70, it's 15 years down the road. At a very historical average rate of appreciation of 4.8%. Remember, appreciation is compounded. So it goes up 1 year, and then the new appreciation is based on the sum total of the year before. So it's compounded appreciation. Some years you might have zero. Look, these last couple of years we're looking at 22%. Are we going to see those again? I don't know. But could we see a year where we're 7 and a year where we're 3, averaging 4 or 5? Absolutely. So 4.8% in 15 years. That property you paid $350,000 for, again, 4.8% average appreciation becomes, that property is now worth $883,849. But guess what also happened? Your mortgage balance decreased. And guess who didn't pay for it? You didn't pay for it. Your tenant did. Your tenant built wealth for you. So if you amortize that mortgage that we just talked about, the balance after 15 years is going to be $182,409. What does that mean? $883,849 home. You sell it for that number. Yeah, it's a pretty specific number, but you know what I'm saying, right? And you subtract out the mortgage balance, leaves you a $701,440 gross profit. Now what do? Subtract out the $99,000 of your original investment. You get that money back too, and you've increased your assets by a little over $602,000 in 15 years. And you didn't pay anything but that money you put up front. And here's the questions I know I'm going to get. Again, click the link in my bio. We want to do this one-on-one for you if you're considering about purchasing investment property. And here's what I get all the time, questions and comments on social media is, well, what if we have a year where there's depreciation? That can happen. But again, we're using an average, right? And the other side of the coin too is, does it matter even if that property never appreciated beyond the 350? Because why doesn't it matter? The tenant is paying down your mortgage. You're not. So you get income coming in, a couple $100 a month, and on top of that, potential write-offs for and against your taxes. Why? Investment property is filed on, if you do it individually, not as a corporation or something like that, it's filed on what's called the Schedule E of your taxes. Now you take your gross rents, you get to subtract out your mortgage interest, your property taxes, your homeowner's insurance, repairs you put into property, and you can depreciate your property. And most people, because of those numbers, wind up, even though they're grossing a couple $100 a month in cash flow, after those things get written off, they're showing a loss, which reduces their tax basis. So why not look to purchase an investment property for legacy wealth creation? So down the road, you've got something for your heirs and beyond. And then money to retire off of to increase what you're already doing. Again, we want to discuss it with you and your financial planner, your financial service professional. We'd love to include them in a conversation with your accountant. We'll walk through these numbers for you one-on-one. Click the link in my bio, and we want to talk to you, and we want to work through this for you. It's great. I love you guys. This is Frank at Advisors Mortgage Group Freehold. Can't wait to talk to you soon.